Hi everyone, welcome to our video for World Economy. Today we'll be discussing the economic implications of monetary policy, from basic theories to recent examples and trends. We'll discuss what monetary policy entails, the forms it takes, and some supporting theoretical frameworks. Along the way, we'll talk about different monetary policy trends across the world's primary monetary authorities. The ultimate goals of economic policy, including monetary policy, are low unemployment, stable prices, and sustained growth. Monetary policy involves central banks influencing the circulation, volume, and velocity of money in the economy through various policy levers, such as policy interest rates, open market operations, and bank reserve requirements. They guide these policies by setting targets for various economic variables. A dominant targeting regime today is inflation targeting. Inflation is a general increase in consumer prices and is thought to arise due to gaps between the estimated long-run trend in output and the actual output. In inflation targeting, central banks monitor the output gap to guide policy. If recent actual output was above the estimated long-term trend in output, inflation would be expected to rise, and if this expectation was above the target range, central banks would act to curb inflation, and vice versa. Since 2012, the US has set an inflation target of 2%. The proposals for review were put forth at the start of the year. In the case of the UK and the EU, the targets are likewise set at 2%. In this table to the left, we can see that the UK and the US since 2016 have had inflation rates within 1 percentage point of the target, while the EU has mostly been scratching the lower bound. On a medium-term timescale, all three regions have been within 1 percentage point below their target rates from 1998 to 2007. Monetary policy is conducted by using policy levers to influence the money supply. In economic downturns, the central bank increases the money supply, lowering interest rates and indirectly spurring output growth by encouraging further investment and consumer spending. Theoretically, this would spur inflation and hopefully improve employment outcomes. Key factors, however, are 1. The proportion at which additional dollars are spent, and 2. The proportion of additional dollars deposited and lent throughout the banking system. If people don't spend, or if they aren't deposited in or lent out by the banking system, output doesn't grow as fast as expected. Two of the main policy levers are the interbank overnight borrowing and lending rates, at which banks lend and borrow to meet capital requirements. Additionally, the capital requirements themselves could be changed, albeit less commonly done. Central banks could also trade government securities with private sector financial institutions through open market operations. During the global financial crisis, monetary authorities around the world also came up with unorthodox expansionary policies, chiefly quantitative easing, wherein the central banks would purchase private sector financial assets of varying maturities from commercial banks. The barrage of expansionary policies throughout the crisis drove interest rates across the US, UK, and EU to or near zero, in the hopes of spurring an economic recovery at the risk of runaway inflation. Today, interest rates remain at historically low points. Many believe that contractionary policies are timely, so that there is room for expansionary policies in case of another downturn. For instance, John Taylor advocated a steep monetary tightening, guided by the eponymous Taylor Rule, a simple tool for fitting monetary policy decisions in inflation targeting regimes, which prescribed a Fed funds rate of 3.7% under the current 2% inflation target. The US Federal Reserve took the lead in setting contractionary policies, first stepping up policy rates in December 2015. This led to a period of monetary divergence between the US and other developed nations, whose policies remained chiefly expansionary. This divergence began to end last year, as the Bank of England raised its bank rate by 25 bips, and as the European Central Bank began to signal a slowdown in its quantitative easing program. The speed at which contractionary monetary policy could be conducted, however, and the long-term impacts of the quantitative easing programs released in 2007 are still largely uncertain. How sensitive would output growth, prices, and employment outcomes be to future contractionary policy? took more than 7 years for the U.S. unemployment rate to reach pre-crisis levels, and how would the monetary tightening impact developing nations, who've enjoyed substantial capital inflows and investment following the expansionary policy regimes.